In 2008, the financial world came crashing down. Stocks plummeted, homes were foreclosed, and the global economy fell into chaos. Almost everyone was blindsided, except for one man. His name was Peter Schiff. Now, if y'all don't know who Peter Schiff is, he's an American financial commentator, economist, and businessman known for his strong advocacy of Austrian economics, free markets, and his critical views on government monetary policies. He's gained recognition for his predictions about economic events and his outspoken opinions on financial and economic issues. While economists cheered the housing boom, Schiff warned about an unsustainable rise in home prices, reckless lending, and the ticking time bomb of mortgage-backed securities. People laughed at him, dismissed him, and they called him Dr. Doom. They gave him nicknames, but then everything he said came true. So how did Peter Schiff see what others missed? And what makes his predictions so eerily accurate? What is he warning about next? Today, we're going to dive deep into Peter Schiff's extraordinary track record, from calling the 2008 financial crash to predicting the dollar's decline, gold's significant rise, and even the volatility of Bitcoin. We'll also uncover his latest warnings about runaway inflation, skyrocketing debt, and a potential economic collapse just around the corner. We'll also uncover his latest warnings about runaway inflation, skyrocketing debt, and a potential economic collapse just around the corner. Buckle up, because you're about to see how Peter Schiff was able to predict numerous economic events that were not foreseen by mainstream economists. Let's start with number one. One of his biggest claims to date is the 2008 financial crisis. Before the 2008 financial crisis, most economists failed to predict what was going to happen. However, as early as 2006, Peter Schiff was able to predict the financial crisis. He warned about an unsustainable rise in home prices, excessive lending practices, and the risks posed by mortgage-backed securities. Back in 2006, he warned of that housing bubble. He came on shows like CNBC and Fox Business and went against the whole consensus. He argued that rising prices could not last and that the mortgage-backed securities were a house of cards waiting to collapse. The housing market eventually did collapse. This was the outcome, and it led to a global financial crisis and a recession. So what does he predict now? Well, he predicts that the next major financial crisis will happen very, very soon, in the next few years. It'll be driven by runaway inflation and a weakening US dollar. Inflation will accelerate faster than most people expect, which could lead to an even bigger financial crisis than the 2008 recession. US Treasury bonds will become the new subprime mortgages due to the unsustainable level of US debt. Number two, the dollar weakness. He first warned about a weakening dollar as early as the 1990s, when he stated that the excessive money printing and growing national debt would erode the value of the US dollar. And what do we see since then? Well, since the 1999, the dollar has officially lost 50% of its value. The dollar has also gone from accounting for 71% of the global foreign exchange reserves in the year 1999 to now only making up 58% of all the global foreign exchange reserves. And it's now 2024. So the dollar's share in global trade transactions has also declined from 80% to 60%. And so what does Peter Schiff see now? Well, he sees that the dollar will continue to lose its status as the world's primary reserve currency, and the dollar index will fall significantly, possibly below 90, and that a full-blown dollar crisis could occur as soon as 2025. Number three, he predicted gold's rise. He has been constantly predicting a significant rise since the late 1990s. Since then, gold has increased 845% since 1999. Going from $280 an ounce to now over $2,650 an ounce. It's an insane amount, and it's going to keep going up. And in 2022, central banks bought 1,136 tons of gold. This is the highest annual amount since 1950. And so they're buying at record levels, more than ever. And they're really serious about this de-dollarization thing, especially with BRICS. And now they added 9 new countries, so they're making up half of the population. of the global population. And so it's a big thing. And what does he say now? Well, he's more bullish on gold than ever. Uh, we're going to see substantial increases due to the US dollar's uh, continuous decline, and gold could rise up to 3,000 in the next year, and even as high as 25,000 or $100,000 an ounce in the next decade or so. This will be caused by the Federal Reserve's continued money printing. Number 4, Peter Schiff predicted the inflation that we're seeing. Since the mid-2000s, he warned that loose monetary policy, low interest rates, and the government spending would lead to significant inflation. In June 2022, CPI reached a 40-year high of 9.1%. By the end of 2023, CPI was still at 3.1%. And it's not just that, but when you actually look at the individual prices of different things since the year 2000, you can see how much everything has gone up. Home prices have gone up 153%. Family health insurance have gone up 267%. College tuition, 67%. Gasoline prices, 133%. Food costs are up 145%. And if you buy a new car, it is now 105% more expensive than if you bought it back then. And what does he predict now? Well, he says that inflation will resurge significantly in 2025, especially with the Fed cutting interest rates. And it'll reach new highs. Back then, when we had the inflation of the 70s, the Federal Reserve had to raise interest rates to 20% to bring inflation back down from 13%. But now the Federal Reserve can't do anything past 5% before cutting again. So that just shows you how weak our economy is. And we're going to see really high inflation rates, and increased government spending and trade deficits will just make it so much worse. Number 5, he predicted the post-2008 stock market volatility. He warned that the economic recovery would not be stable, with significant market volatility fueled by unsound monetary policies. And what did we see? Well, the stock market experienced significant ups and downs, particularly during events like the 2011 debt ceiling crisis and the COVID-19 pandemic. The CBOE volatility index hit extreme levels during 2008 and 2020. Number 6, Peter Schiff predicted the Federal Reserve's reliance on low interest rates. Since the mid-2000s, he warned that the Federal Reserve would struggle to raise interest rates without harming the economy and would be trapped in a cycle of low rates. And what do we see since then? Well, the Fed kept interest rates near zero for over a decade after the 2008 crisis. And it struggled with rate hikes, as seen during the 2018 market sell-off, known as taper tantrum, where they tried raising rates, but then they had to cut them again because the economy couldn't handle it. And then they tried to raise rates again in 2022. They got up to 5% to combat high inflation that we had. But now that they decided to cut again before reaching our target 2% inflation rate. And that tells you that the economy is weak. So what does he say that'll happen now? Well, the Fed will continue to cut rates in order to keep asset prices afloat. And this will result in a further weakening of the US dollar. And it'll increase inflation pressures. He states that the Fed has lost the inflation fight already and will have to continue cutting rates regardless of what the Federal Reserve says, regardless of what the media says. It's going to have to cut rates, and it's going to cause another wave of inflation. Number 7, he predicted the European debt crisis that happened in 2010 from that point to 2012. In 2007, he foresaw that excessive government spending and unsustainable debt levels in Europe would lead to economic crisis, particularly in countries like Greece, Italy, and Spain. And what was the outcome? Well, the Eurozone faced a sovereign debt crisis. And it was so bad to where the European Central Bank, the European Union, and the IMF, they issued bailouts with austerity measures to countries like Greece, Ireland, Portugal, and Spain. And what does he see now? Well, he cautions about the potential for economic stagnation and the erosion of the euro's value due to the region's ongoing struggles with debt and inflation and low interest rates, what we see everywhere else. And he suggests that they may be headed for another debt crisis similar to 2010. Number 8, he predicted the U.S. trade deficit worsening to the levels that we see today. Since the early 2000s, he predicted the trade deficit would grow due to offshoring of manufacturing and reliance on foreign imports. Since then, the U.S. trade deficit has steadily increased from $400 billion to reaching a record high of $800 billion in 2006, and then another record high of $900 billion in 2022. And he predicts today that the trade deficit will continue to worsen and will eventually contribute to a broader financial crisis as the dollar weakens and inflation rises. Number 9, he also predicted Bitcoin's volatility. As early as 2011, when Bitcoin was in its early stages, he criticized it as speculative and warned of its extreme volatility and susceptibility to major crashes. Since then, Bitcoin has experienced massive booms and busts, including a 94% drop in June of 2011, an 80% crash in 2018, a 75% drop in 2022 after reaching all-time highs, and another 50% drop in 2023. His current outlook on it is that he's still highly skeptical, and he believes that it's a big bubble and its value is unsustainable. He predicts Bitcoin's price will eventually collapse because it lacks intrinsic value and operates more like a speculative asset than a stable store of wealth. He says the losses will be enormous, and he calls it one of the biggest misallocations of resources in history. Number 10, wealth gap growth. Around the time of the 2008 financial crisis, he warned that the Federal Reserve's policies, particularly quantitative easing, also known as QE, and low interest rates would contribute to income and wealth inequality by inflating asset prices. He argued that the wealthiest individuals and large financial institutions would benefit most from these policies because they're the primary beneficiaries of asset price inflation, such as in stocks and real estate. Meanwhile, ordinary savers who do not have access to leverage or significant investments in assets would lose out as inflation erodes the value of their savings. And what did we see since then? Well, the wealth gap has widened as asset prices surge and wage growth for the middle class has remained stagnant, benefiting the wealthy more than the lower income households. In 2007, the top 1% held 34.6% of the country's wealth. By 2021, it reached 40%, with 70 to 80% of it tied up in financial assets. Wealth inequality has reached levels not seen since the 1920s. So he was right. The wealth gap was going to get bigger. And what does he say now? Well, he says that it's going to continue to worsen as a result of ongoing monetary policies like QE, low interest rates, and massive government spending. Number 11, China's economic rise. He predicted as early as the mid-2000s that China would become one of the world's largest economies due to its manufacturing base and growing middle class. And by 2009, China surpassed Germany to become the world's largest exporter and the third largest economy. And in 2013, it replaced Japan as the world's second largest economy. We also see that from 2000 to 2020, China's middle class grew by hundreds of millions of people. And what does he say now? Well, he's cautious about the future of China, and he predicts that it could surpass the U.S. anytime soon as the world's leading economy. As the U.S. weakens its currency and faces economic instability, there's just nothing holding China back. And last, but definitely not least, he predicted our government's current debt crisis. Since the early 2000s, he warned about unchecked government borrowing leading to unsustainable debt levels. National debt has gone up from 5.7 trillion in 2000 to now surpassing 36 trillion in 2024. Interest payments alone now exceed $1 trillion, which is more than our military budget, which is the highest in the world, and 50% more than the next 10 countries combined. We're now adding an annualized rate of almost $4 trillion a year based on the past couple of months, and from 2000 to 2024, our national debt while economic growth was Our current debt to GDP ratio is sitting at 123%. This is what we had in 2021, right after the $5 trillion in stimulus spending and shutdown of the economy for COVID. However, this time around, we had no pandemic or government shutdown. And this ratio is even higher than what we had during the whole length of World War II and the Great Depression, which is when it got up to 119%. And we thought that was high. But we're all about breaking records. So from 2015 to 2024, foreign holdings of U.S. debt dropped significantly from 34% to only 23% of the total. The largest foreign holder of U.S. debt, China, has dramatically reduced its holdings from a peak of 1.3 trillion in 2011 to now, in 2023, only 850 billion. From 2018 to 2019, Russia reduced its holdings by 90%. Before the Federal Reserve began quantitative easing in late 2008, the Federal Reserve held 5% of U.S. bonds. Now it holds 20 to 25%. So it's a lot more now. And Peter Schiff sees the U.S. government's increasing reliance on debt to finance its deficits as a ticking time bomb. He predicts investors will continue to question the country's ability to repay its debt, which will continue causing higher borrowing costs, which will lead to a debt spiral, where the U.S. is forced to borrow more and more to pay off its existing debt. This will cause the U.S. dollar to eventually collapse in 5 to 10 years. As the U.S. continues to print money to finance its deficits, he sees the possibility of debt restructuring or default by devaluing the dollar or implementing hyperinflation. So how is he so good at predicting all these economic events? And what makes his opinion so worth noting? Well, one, he has a deep understanding of Austrian economics. What's Austrian economics? It's the perspective that focuses on long-term consequences of inflationary policies and debt accumulation, which many mainstream economists overlook. The Austrian framework's skepticism about government intervention, especially in the form of low interest rates and quantitative easing, helped him foresee the problems that would arise from such policies. He also focuses on market fundamentals such as debt levels, credit growth, and inflation, which he believes is what contributes to economic booms and busts. His ability to track these factors closely and recognize unsustainable trends set him apart from mainstream analysts who are overly optimistic during the pre-crisis years. He's also known for his contrarian approach, often positioning himself against the consensus of the financial establishment. While many economists were bullish on housing, consumer spending, and the stock market in the mid-2000s, Schiff was one of the few publicly warning about the potential crash. His investment strategies also reflect this contrarian approach, focusing on gold, foreign currencies, and other assets that would benefit from the fallout of inflation and the dollar depreciation. He also shows a very good understanding of the Fed's role as he analyzes their actions and their consequences on the dollar and the economy. It allowed him to foresee the eventual fallout. He consistently warned that the Fed's intervention would create long-term inflationary pressures and destabilize the economy, predictions that have gained traction as inflation has risen in recent years. And last, he has a real-world focus. Unlike many economists who are entrenched in academic theory or government policy, Schiff has maintained close ties to real-world financial markets. The practical experience, combined with his philosophical outlook on economics, gives him a unique ability to make predictions that are grounded in pragmatic analysis rather than theoretical models that rely on assumptions about economic behavior. His consistent success in forecasting economic events stems from his holistic understanding of economic forces, his contrarian mindset, and his adherence to sound economic principles, particularly those from the Austrian school of thought. So I want to ask you guys, will you take his advice? And will you align your financial and investment strategy along with his? Or is he just another doomsayer and the economy is going to do great in the coming years? Let me know down in the comments. I think I'm going to side with him because he's been right in the past and he has a good track record and everything he says makes sense to me. Anyway, I'll see you on the next time.